Telus is a top Canadian telecom company which today is paying a fairly high yield of 8%. That can potentially look great inside of a tax-free savings account, as that could generate a whole lot of dividend income for you. And while that might catch your attention, a yield this high often comes with some risks. Let's take a close look at Telus and see if the payout is really sustainable and safe, and whether the stock is a good buy. The first red flag is Telus' payout ratio, which has climbed to well over 100%. Essentially, the company is paying out more in dividends than what it earns in net income. That's not a sustainable long-term strategy and raises questions about how Telus can continue making high dividend payments without stronger earnings growth down the road. Adding to the concern, Telus is just barely covering its dividend with free cash flow. Over the past year, the company is generating $1.6 billion in free cash flow, just edging out the $1.5 billion it paid in dividends. While that technically covers the payout, it doesn't leave much room for error, especially since free cash flow has varied from quarter to quarter. As you can see from this chart, which shows free cash flow less dividends paid, there have been multiple quarters in the past where Telus hasn't been generating enough free cash to cover its dividend payment. That being said, cash flow does and will fluctuate from one period to the next, so this isn't necessarily a huge issue since over a 12-month period it's still done okay. But this is something investors should watch out for nonetheless. Now, despite these challenges, Telus' management appears confident. The company recently raised its quarterly dividend to just over 40 cents per share, marking the 27th increase since 2011. This suggests optimism about future cash flow, but investors should remain cautious. Any prolonged pressure on earnings or cash flow could put this confidence to the test. A big reason the yield is so high is Telus' stock price. Shares are down 16% year to date, which means investors are collecting the same dividend for a cheaper price. And when you factor in the dividend has been growing, that pushes the yield even higher. The stock's decline this year partly reflects broader market conditions like higher interest rates and increased competition. And technically, the sell-off has been so bad that the stock is trading at more than an 8-year low right now. It hasn't been at these levels since 2016. But as interest rates continue to come down, could the dividend stocks start rallying again as investors start to look for high-yielding stocks? That's the big question heading into 2025 for Telus. Telus' recent third quarter results weren't all that bad. On the bright side, the company added 347,000 net new mobile and fixed customers, a strong performance in its industry. Mobile phone net additions reached 130,000, with churn staying low at 0.9%, indicating strong customer loyalty. Telus also gained 34,000 new internet customers thanks to its pure fiber network and bundled service packages. In addition, Telus reported a 58% jump in consolidated free cash flow, which is also a good sign. However, revenue growth in its digital experience segment faced pressure from a tough macroeconomic environment and rising competition. Plus, Rogers' acquisition of Shaw could intensify market competition moving forward. But management continues to emphasize the long-term stability of its dividend. Telus points to its strong broadband networks, diversified revenue streams, and strategic investments in sectors like health and agriculture as key pillars for future growth. The company has returned more than $21 billion in dividends to shareholders since 2004, and management still looks determined to make Telus a great dividend stock to own for years to come. But there's still some risk here. The elevated payout ratio, tight free cash flow coverage, and competitive challenges ahead are all significant factors to watch out for if you're thinking about buying Telus stock. While the company is still doing okay, this is not a stock you should just buy and forget about. For now, Telus' dividend still seems safe, but that could change depending on how it performs in the future. I still like the stock as a potential contrarian pick. That's because it's still a top telecom company in Canada and a market leader. Its yield is high, the stock is trading at a huge discount, and I think it can recover as interest rates continue to come down. In a few years, this could look like a steal of a deal. If you're willing to be patient with the stock, I think this can be a good option to put in your TFSA, as you could not only generate a lot of dividend income from Telus, but should the stock recover, you could also profit from some great gains as well. There's some risk here, but Telus isn't going anywhere anytime soon.